Welcome back, everyone. In the age of AI and big data and high-speed internet and everybody shopping online and basically conducting their entire lives and business online, it's probably no surprise that cyber attacks are on the rise. So here I'm using Perplexity. I prefer Perplexity because they will cite their sources, and I haven't really had any issues with funny sources or suspicious data or anything like that. And I just asked Perplexity to give me an idea about the number and severity of cyber attacks that are out there, and very large volumes of cyber attacks. So around 8 million DDoS attacks recorded in just the first half of 2024. These are becoming very routine. About 893 million phishing attempts blocked in 2024, up from roughly 710 million the year before. That's a 26% jump year over year. I think we could all agree that a 26% increase in our stock market portfolio would be fantastic. Well, that's unfortunately a 26% jump in phishing attempts. These are growing. Phishing activity reported as increasing by more than 4,000% since late 2022. So in 3 years, it's gone up by 4,000%. The number of ransomware victims posted online leaks on leak sites rising about 15% in a single year. High impact ransomware stats. So 5,414 ransomware attacks on organizations counted in one 2024 data set, with roughly one third happening in the fourth quarter alone. Average extortion demands above 5.2 million USD per incident, and at least one public ransom payment of about $75 million in 2024. Sector and outage severity. So healthcare got hit by over 2,000 attacks per week globally in early to mid 2024, with a 32% year over year increase. One software related outage in 2024, driving about $5.4 billion in total direct losses, including 1.9 billion USD in healthcare and $1.5 in banking. Macro level cost projections. So global cybercrime costs projected to reach about $10.5 trillion in 2025 and grow to roughly 15.6 trillion in 2029. So in 4 years, it's going to go up by 50%, up to $15.6 trillion. Now, the average cost of a data breach at around $4.88 million globally per incident in 2024, which makes even single breaches economically severe. So this is a problem. It's a growing problem, and companies are going to want to protect their data. They want to be reliable. They want you to feel secure shopping and giving your data to them. And so companies are going to spend big dollars on cybersecurity software. And so what we're going to do in this video today is we're going to look at what are the best companies in that space. Where should we put our money, if anywhere? Are there any opportunities in cybersecurity? So we're going to take a look at 5 different companies. We're going to look at QLYS, we're going to look at Checkpoint, Palo Alto Networks, Fortinet, and Cisco. And we pointed out in a recent video that stockanalysis.com's comparison tool, it's okay. It kind of has like a delay. I think it's actually taking from the previous day's data and starting it the next day, which is why not all these are starting at 0%, but pretty close and pretty good for our purposes. And what you can see for the past month is mixed results. All right. So Palo Alto Networks down 12%, while Cisco is up 10%. And we're going to come back to this later, but Cisco, of all these companies, is the only dividend payer. It's giving you a healthy 2.08% dividend, and it's been paying dividends for 15 years consecutive now. So Cisco is something that if you wanted a little bit of dividend, a little bit of cash flow in your account, Cisco might be the way to go. Basically, everything else in the space is new, it's growing, they're expanding, and so they're putting that capital toward research and development, not dividends. Okay, past 3 months, we have kind of a first in place that are pretty close. We have Cisco and QLYS together. And again, Palo Alto is down 3.5% in the past 3 months. In the past 6 months, Cisco is still the winner, 23%, while Fortinet is down almost 19%. Checkpoint down about 13.5%. Palo Alto almost even, maybe a little bit down at 2.85%. So in the past year, Cisco is the clear winner. Okay, Cisco is absolutely dominating it relative to these other companies. So does that mean that Cisco is the best company of these 5, or are there some plays in here that we can kind of sneak in and get while they're beaten down. Now I'm going to refresh this because it was throwing up those dots again. But here we have the 3-year chart. And in the 3-year chart, we see the Palo Alto is the winner, doubling the return of Cisco, almost doubling it, 140% versus Cisco's 79%. And QLYS is only up about 29%. Over 5 years, we can see that Palo Alto is the winner there. And in the past 10 years, well, the winner there is Fortinet. So depending on when you get into these companies is very important. Okay, if you got into Checkpoint 10 years ago, you're up 134%. That's about what the market's going to return. Where Fortinet, you're 10 timesing the return essentially. Okay, so when you get into these companies, it's absolutely critical, absolutely important. And so that's what we're going to discuss today is which of these companies right now in December of 2025 are the better buys. So we are only looking at these companies in terms of growth companies. The only one that offers any dividend, like I said, is Cisco. Everything else on this list is a grower and a big grower. And so they're devoting all that capital to growth, not dividends. And I have a couple others on here. CrowdStrike down, it's in the negative scoring realm. Now remember our scoring method on this channel, we rank things from -10 to +10 based on some proven scoring systems that we use on this channel. So anything that's negative, we're going to kind of throw away. Anything 1 to 2, also not too terribly interested in. Nothing really cracks the 6-point mark, unfortunately. So we're going to be looking at these 5 that we looked at earlier. And if we look at the numbers here, there are some very impressive numbers that stick out to us. So QLYS, what's making their score very high is they have very good return on equity, return on invested capital, and pretty healthy profit margins at 29%. The only healthier profit margin on this list is QLYS at 37.6%. They have basically no debt, and they have a fantastic 5.4% free cash flow yield. We can see that the 5-year forward PE for a lot of these companies is phenomenal. Not Palo Alto, unfortunately, at 41.2. And remember, that's 5 years from now. And the tech sector lately has been in the high 30s or low 40s for average PE. And so this is encroaching on just average. CrowdStrike is at 61.5. Very much not interested in it. Really, the only thing that CrowdStrike has going for it is pretty decent revenue growth at 21.4%. Now, the 2 companies that have the best 5-year forward PE are Sentinel and 10B, but we're going to throw those away because their overall scores in basically every other category is so low. And the only reason why the forward PE is so low and therefore attractive for us is the fact that their expected EPS growth is 105.6%. Again, that's over the next 5 years. I don't know if they can do that. Okay, so that's very speculative. That's very risky. They have no debt. Their PEG ratio is fantastic at 0.5. But ultimately, what's giving them any sort of life in the scoring system is their high expected EPS growth for the next 5 years, giving them a very low 5-year forward PE. So we're going to toss those. Okay, now Fortinet, return on equity, fantastic. Return on invested capital, very, very nice. It's why they're cracking the 0 mark essentially and getting into the 3s. So these are the 5 companies that we're going to look at. Checkpoint, not CrowdStrike, I'm sorry. Checkpoint, Palo Alto Networks, QLYS, Cisco, and Fortinet. And we're going to check out what are their intrinsic values. And should we buy these? Should we hold them if we already hold them? Should we sell them if we have them in our portfolio? What should we do with these companies? Now, in terms of intrinsic value, we're going to start with Cisco, mainly because it's the only one that we can evaluate with the PE ratio multiples calculator and the dividend discount model. Now, remember, we went through these in the channel. I showed you how to build these on your own. So if you go down to the description of this video, there will be 2 links that will show you how you can make these spreadsheets in Google Sheets on your own. So you can run your own projections, your own valuations for basically any company that you want. So Cisco, remember, we're being conservative on this channel in 2 ways. And so whatever their expected EPS growth is, I'm going to knock it down maybe a percent or 2. And I also have the scale down factor that assumes that years 6 through 10, the EPS growth is actually half of the rate of what it was in years 1 through 5. So we can see here, Cisco, we have an intrinsic value of about $81. Now, the dividend discount model, we require a return of 8%. Their dividend growth rate year over year is 2.5%, and their current dividend is $1.64. Unfortunately, that makes the intrinsic value of Cisco $31. And so we're not going to get a too good of a intrinsic value for Cisco, because that value of $31, that margin of safety of negative essentially 160%, is not going to serve it well in the intrinsic value calculations. Now, QLYS, we are assuming they are going to grow EPS at about 8% per year for the next 5 years. What we do see here is that the forward PE, the 10-year forward PE, is about 27, and that's okay, I suppose. It's currently at 43, or 40.37 rather, and we can see it going down nicely, but we like 10-year forward PEs to be very, very low. We want to see that massive EPS growth really knock down those multiples over time. And so the fact that this is severely overvalued, margin of safety of negative 55%, and the fact that the PE ratio in 10 years is probably going to hover in the mid 20s, not too terribly excited about this one. Now, Checkpoint, that's a different story. We see expected EPS growth of about 10% per year for the next 10 years, rather for the next 5 years, and then we knock that in half to 5% for years 6 through 10. We can see a very healthy 10-year forward PE in the 13s. That's fantastic. And we see intrinsic value of $268 with the current price just under 200. So the margin of safety there is 26. On this channel with Interflame Investments and Finances, we like margins of safety at least 20%. So this is something that we are going to keep our eye on. Now, once again, on the other side of things, there's Palo Alto. EPS growth coming in at 20% still gives us intrinsic values of about $84, and a 10-year forward PE still in the mid 40s. So not too terribly interested in Palo Alto Networks. They probably grew too much too fast, and we're going to hold off on them very likely in the near future. And finally, Fortinet, we see that with 10% EPS growth over the next 5 years, and then 5% after that, Fortinet's giving us an intrinsic value of $71, currently trading for $82, so we're not too terribly interested in that either. And we also see a 10-year forward PE in the low 20s. That might give it some basis for value, and maybe we'll put it on a watch list. If it falls about $10, it will be in the range of intrinsic value. So we would certainly want it to go under $71. So this is something that we might keep on our watch list. Now, once again, nothing that we say on this channel is investment advice. I'm not saying to buy anything, sell anything. I am not telling you what to do in your portfolio. That's for you to decide. Do your own due diligence, do your research, do your own homework. That being said, if hypothetically somebody were to have $100 that they would wanted to invest in the cybersecurity space, and they narrowed it down to these 5 companies, which would they choose, if any? Well, just looking in the margin of safety column, we see that everything is overvalued except for Checkpoint. Checkpoint has a 25.9% margin of safety. Its price is currently $198. It is valued at $268 using our PE multiples discount model. And so when I click and drag this down, we're going to see that's the only one we're going to buy. All right. So if we had $100, really the only company that gets our money is Checkpoint. Everything else is overvalued. It's got the second highest score overall at 5. QLYS comes in at 5.6, but right now QLYS is just too expensive to look at. If the price comes down into the double digits, maybe we're going to start looking at QLYS. But as with anything, you want diversification. And so if this $100 is the only $100 that you have to invest, you may not want to put that all into one company in one sector. Okay, so that gets into the art of diversification and where do you put your money. So, but if this $100 you've reserved for specifically cybersecurity stocks, then you would put all your eggs in that one basket, at least as far as today's valuations are concerned. So thanks for watching. Like and subscribe. Tell your friends. Appreciate you watching, and we'll see you in the next video.